Hello and welcome to the Ducker Frontier webinar, APAC's Consumer Landscape in the Year of the Coronavirus. I am Raveen Krishan, Client Relationship Manager for Asia Pacific at Ducker Frontier. Before we get started, we realize that some of you may be new to Ducker Frontier. So we'd like to take 1 minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. Ducker Frontier is a leading market intelligence and consulting firm that provides tailored solutions to drive growth for clients across the consumer, B2B, healthcare, and technology sectors. Our dedicated team serves as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. With continuous research and insights, custom solutions, and transaction support services, we provide our clients a small sample of which you can see here, with timely, actionable insights to adapt and win in changing markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. For more information, please visit www.duckerfrontier.com. Having briefly introduced our company, I'd like to take a moment to briefly introduce our panelists today. We have 3 members of our research team on the line for today's webinar. The first is Adam Jazik. He leads the research team for Asia Pacific at Ducker Frontier, and will be sharing insights on what we're hearing from our regional executives and China GMs. The second is Pratima Singh. She is a practice leader in our Asia Pacific practice here at Ducker Frontier, and will be sharing insights on South Asia. And the third is Ashu Agarwal. He's a senior analyst in our Ducker Frontier research team, and will be sharing insights on Southeast Asia. As members of Ducker Frontier's research team, Adam, Pratima, and Ashu support senior executives on key initiatives, including strategic planning, resource allocation, and risk management, among others. Because they are in constant contact with our clients, they will be discussing not only the results of our research, but also what we've been hearing from multinationals who are being impacted by the coronavirus. If there are any insights you see today as part of this discussion, or any questions we don't get to answer, our client services team, Sarah, Althea, Yuchen, and I, will be happy to follow up with you directly. To give you a better sense for how we intend to do that, I'd like to turn things over now to Adam to take us through our agenda.
Thanks, Raveen. Our webinar today will consist of a 50-minute presentation followed by Q&A. To be specific, I'll begin the session with a discussion on how forecasts for growth in Asia are shifting and the assumptions underpinning those figures. I'll then share the outlook for China with a particular focus on the degree to which consumer behavior is normalizing. I'll then hand things over to Pratima, who will share our outlook for India in 2020. She'll discuss how the COVID-19 epidemic is impacting the Indian economy and highlight key challenges that companies will face in the coming quarters. Once she's finished, Ashu will take the lead and discuss the outlook for Southeast Asia. Specifically, he'll discuss the coronavirus's ripple effects on the region and what to expect in terms of recovery across Southeast Asian markets. We'll then round out the session with a Q&A. So if you have any questions or points of clarification regarding any of the topics that we covered today, please don't hesitate to send them to Ducker Frontier Webinars via the GoToMeeting messenger by clicking on the Q&A box on the right-hand side of your screen. And we'll do our best to ensure that they're addressed in the Q&A period. So without further ado, let's get started with the outlook for Asia Pacific in 2020. We can't talk about the outlook for Asia Pacific without first talking about the broader global environment. The reality of the situation is we're headed into a global recession this year. In fact, if you look at the most recent PMI numbers that are coming out of the US and Europe, one could argue we're already in a global recession this year. Major markets around the world are falling into contractionary territory, and this is going to have significant implications for Asia Pacific. You can see that particularly if you look at the chart on this slide. What we've done here is outline consumer spending forecasts by vintage. In other words, we've compared our forecasts for consumer spending growth for various regions around the world. We've taken our consumer spending forecasts for various regions around the world from January and put them here in blue. We've compared them to the exact same metrics, but as we see them now in April. You'll see that there's been a massive drop-off around the world, and few places have been hit as hard as North America. And in some cases, if we break that Western Europe number out, many European markets as well, places like Italy. In this environment, even if you're able to escape a major domestic outbreak, there's no escape from the ripple effect. So it should be no surprise that Asian countries across the board have been revised down. What you see on this slide is a very similar chart to what you saw in the last, except instead of looking at regions, we're now looking at countries across Asia Pacific. You'll see that countries around Asia Pacific are now expected to experience much lower levels of consumer spending. And that's not just limited to countries that are smaller and more exposed to the external environment. It includes major stalwarts of growth that Asia Pacific executives have historically counted on to really bolster and stabilize the revenue generation capability. Regrettably, there's a very good chance that we're going to see additional revisions in the coming months because Asia is in the middle of a second wave of COVID-19. If you take a look at the chart on the screen, what you'll see there are active COVID-19 cases laid out for major markets around Asia Pacific. When we say active COVID-19 cases, what we mean specifically are the total number of cases minus the number of people who have recovered minus the number of people who have died. So these are the number of coronavirus cases that have been measured that are still very much active in the community. Now, I recognize here that there's a lot going on in this chart, so I'd like to break it down for you. There are two things to note here. The first is the shape of the overarching curve, right? It peaked initially in mid-February, and then it came back down. We're now heading back up towards another peak, a second wave, if you will. And that number, that total is heading straight back to where we saw it in the past. It will probably grow taller. In other words, the size of the second wave is probably going to be larger than the size of the first. The second thing to note here is the composition of the wave. You'll see that the first wave is colored blue, almost in its entirety. That's back when COVID-19 was limited to China alone. But now that wave is much more, is multicolored. It's much more diverse. The coronavirus has shifted out to markets around the region, and as a result, tracking it has become much more complex. Now, the natural question that tends to arise when we see a chart like this is, when we have a discussion like this, is when will this wave crest? And unfortunately, we can't really predict that because surging case counts and rampant undercounting basically make predicting that crest impossible. What you see on the chart in front of you, or in the series of charts in front of you, are active case counts for individual markets. So basically, we took the chart that you saw before and we broke it down by country so you could see the different patterns. What you see here is a wide variation in patterns, right? India, Japan, and Indonesia are all currently driving up Asia's case count. These are really the main drivers behind that second wave, more so than any other market. Unfortunately, their outbreaks are likely worse than reported due to undercounting, particularly in India and Indonesia, but also in Japan. Because these waves are accelerating in their growth, because we don't even know how large the actual epidemics are. Like I said before, it's impossible at this point to make predictions. That's not to say that there isn't reason for hope. I mean, we saw in South Korea, for example, a situation where reliable data was matched with encouraging results. We do expect to see cases continue falling there over the coming months. And if you look at the Philippines and Malaysia, stringent measures in those markets seem to be bringing COVID under control, although the length of time it takes to fully curb the epidemic remains to be seen, because it will depend heavily on government policy. And Thailand and Vietnam seem at this point to be okay. They seem to be in good shape. Vietnam in particular, I think that's probably actually the case. The country took action early and has a consolidated approach led by a relatively centralized government. But unfortunately, these numbers, the numbers coming out of both of these countries are suspect. They both suffer from undercounting, and in particular in Thailand's case, it's really unclear how and why the numbers would be as low as they actually are. It's difficult to believe. So clearly, as mentioned before, predicting the wave's crest is challenging, and that makes planning incredibly difficult. Because after all, in this environment, the single most important question we face for planning is timelines. Because we can't yet make confident predictions based on data alone, and because we have to plan, ultimately what that means is we have to make a series of clear assumptions. And that's what we've done here. We've laid out some epidemiological as well as economic assumptions at the bottom of the page. In terms of our epidemiological assumptions, we've assumed here that COVID is affected by seasons, that it acts like other coronaviruses, other flu viruses in general, and experiences some downward pressure from warmer temperatures. We've also assumed here that COVID is going to act like SARS. That is to say that it is going to peak and then come down, particularly in the Northern Hemisphere, around the May-June time period, and then basically level off. There's potential for pickup in cases in the Southern Hemisphere later on in the year due to the seasonality of the virus. But critically, we've assumed that it will act like SARS and peak only once. With these epidemiological assumptions, we see specific economic assumptions coming out. In China, we expect to see an extended V-shaped recovery, largely driven by fiscal stimulus and stringent government action, as well as the government's control over the financial sector, which allows it to get ahead of some challenges that we see elsewhere. Regrettably, for the EU, for the US, we do not see the same factors at play. We expect there to see a U-shaped recovery, an extended recovery that will take quite a bit of time, probably multiple quarters. Of course, these assumptions, right, are helpful, but naturally carry with them uncertainty. As I mentioned before, this assumes that COVID will act like SARS, that it will peak and then come down, and that'll be it. The reality of the situation is that there's a distinct possibility, a reasonably high probability actually, that we will see the virus resurface during the fall and winter season, likely November, December of this year in the Northern Hemisphere. That risk is real, and companies should be planning for it. Even if it isn't part of your base case, it needs to be part of your downside case. It's critical now more than ever that companies engage in scenario planning on a broad basis. Now, of course, these are our perspectives, but everyone has slightly different perspectives on this topic. Everybody brings different assumptions to the table. And so we didn't just want to give you access to our perspectives, we also wanted to give you access to others' perspectives. So we decided to ask our clients about their views during two recent virtual executive roundtables that we held. We actually held them over the course of this month. And here's what they had to say when we asked them when they expect to see sales start picking up in the markets that they cover. Basically, we saw a curve relatively similar to the one that we laid out. The majority of people we spoke to in Asia Pacific, so those are the bars in light blue here, expect to see sales start picking up in Q3. We did have some people who were a little bit more bearish, others who were a little bit more bullish. But by and large, that's where we saw the average come out. This is actually quite well aligned with a webinar that we hosted in EMEA earlier this month. There we saw a little bit more pessimism, a little bit more bearishness relative to the average, but that's actually not that surprising, given the fact that here in Asia Pacific, we have China to begin bolstering revenue generation for many companies earlier, whereas in Europe, and indeed in much of the rest of the world, there isn't that large market to help bolster growth. So, with these assumptions and the polling results in mind, I want to end with our projections. As noted before, we're currently projecting a U-shaped recovery in the US, in Europe, an extended V-shaped recovery in China. And thus, we're currently projecting a U-shaped recovery in the majority of APAC markets. That's likely to be a bit shallower than we see in much of the rest of the world. In other words, most of Asia Pacific is going to be dragged down by the external environment through Q2, in Q3, probably into Q4, but will also experience a bit of a lift from China over the course of particularly Q3 into Q4. So we recommend the companies plan for a recovery in China in Q2 to Q3 and a gradual recovery to normal activity across Asia in Q3 and Q4. And I just want to note this one more time. Also, we recommend the companies begin building contingency plans for a situation in which the coronavirus resurfaces in Q4. Now, as noted before, China is expected to experience a different recovery shape than most. So I want to make sure that we spend a little bit of time talking about the dynamics at play there in a little bit more detail. So let's go ahead and dive in to our outlook for China. And we'll begin by taking another look at the quarterly forecasts. What you see on the slide in front of you is a comparison of our quarterly consumption growth forecast for China for January, or our current forecast in dark blue relative to our forecast from back in January. This is very similar to what you saw in our first couple of content-oriented slides. Basically, we believe that China will rebound in Q2 on the back of fiscal stimulus, which should help carry it into Q3 and Q4 as consumption normalizes across the economy. Do want to note here that risks are tilted towards the downside. The full extent of the global slowdown remains unclear, and if it is more substantial, if it's more significant than our current forecast, particularly for the US and the EU indicate, then these numbers are probably going to come down more quickly. But with that said, let's talk about our base case. Let's talk about what we see happening here. You see, in speaking with B2C executives about the recovery, one of the most common questions we receive is, when will China get back to work? Specifically, they're looking to determine how long it will take China's industry to get back on solid ground, giving consumers the confidence they need to spend. So let's dig into that question. Because China's government has a very clear narrative. If you listen to the Chinese government, Chinese officials, they'll tell you that China is back to work, that the economy is effectively moving very close to where it was prior to the coronavirus outbreak. You can see that if you look at the chart. It should be projected on your screen, slide 20. There you see the results of numerous business activity surveys released by the Chinese government. You'll see there that they say work normalization rates for state-owned enterprises and state firms are practically where they were prior to the coronavirus. The logistics capacity is above where it was prior to the coronavirus. And infrastructure projects are almost to 90% in terms of their work normalization rate. I mean, even small and medium-sized enterprises are at around 77% in terms of the quote-unquote work normalization rate of where they were prior to the coronavirus. These official statistics, while encouraging, need to be taken with a grain of salt, perhaps a hefty helping of salt. There is some truth there. There's clearly a divide between state-owned enterprises and small and medium-sized enterprises. That's real. no question about it. But the notion that China is back to work to the degree that these would indicate is a bit overdone. We asked our clients about their views during the B2B virtual executive roundtable that we held a couple of weeks ago, and they shared a very different perspective. Instead of, or they believe that the overall number is not between 77 and 99%, as these surveys would have you believe, but instead still below 60%. That's a pretty big gap. And what it means is that although China is recovering, China is getting back to work, China is taking longer to get there than the official cheerleaders would have you believe. It's going to take some more time for China's industry to recover. And that will translate into a further delay in consumption, because the recovery on the economy's demand side is going to lag recovery on its supply side. Take a look at the chart on your screen. What you should see there is year-on-year growth in industrial production and retail sales laid out on a monthly basis. You'll see that these figures were quite stable over the course of the last couple of years, quite stable. But they took a massive dive in the first quarter of this year. And what's particularly interesting here is that retail sales, which historically had grown more quickly than industrial production, contracted to a large degree and have not rebounded to nearly the same degree as industrial production has. We expect a recovery in consumption to lag a broader industrial recovery by at least 1 to 2 months, as indicated by this chart and is indicated by logic. I mean, households in China took a massive hit. They took a massive hit as a result of coronavirus. And it's going to take a little while for consumer confidence to resume, for people to feel confident enough in their jobs, in their income generation capacity, to go back out and spend money. So this view is pretty clear, but we wanted to get into a little bit more specifics. And since we had numerous B2C executives on the line earlier this week, we decided during our virtual executive roundtable to ask them about their view, about specifics around months, and it yielded some pretty interesting results. So we asked the executives we had on the line earlier this week when they expect consumer confidence in China to recover to pre-COVID levels. You'll see here we have the months laid out from April to December, A through I, and then it just not happening at all this year in J. And there's a pretty big dispersion in terms of the results. There's clearly a broad range of views on when China's consumer confidence will recover. We dug into this. We asked them about their views. They shared their views with us. They shared their views with each other. Unfortunately, we were not able to come to consensus. It was clear that executives had a wide range of experiences in recent weeks, and that had yielded a wide range of expectations for the future. But one thing to note here is that less than 20% of the executives that we had on the line expect recovery before Q3, meaning that the dynamics that we saw earlier in the year are likely to persist in the coming months. And one area where we see this particularly clearly is in the online sphere. So take a look at the chart on the left-hand side of the slide. There you should see online retail sales and goods accumulated over the course of the year. So basically what that means is the March numbers for Q1, June numbers for H1, December numbers for the entire year. What you see there is that the February number for 2020 was largely in line with what we saw in 2018 and 2019, which is pretty remarkable given the massive drop-off in overall retail sales that we noted earlier, double-digit contraction. Basically what that means is substantially more product is now moving through online channels, effectively accelerating a trend that we've seen over the course of the last couple of years. And you can see that in the chart on the right-hand side of the screen. There you see online goods sales as a percent of total retail sales of consumer goods. It's been rising quite rapidly over the course of the last couple of years. And we can expect to see that number remain high, well in the 20 to 25% range over the course of this year. The COVID epidemic, unsurprisingly, has made online channels even more critical to B2C multinationals' success in China. Now, there may be for those of you who have been investing in your online channel development, there may be a temptation now that lockdowns within China have been lifted, now that China is quote unquote getting back to work, there may be a temptation for you to shift your focus away from online channels, having just poured a ton of effort into them, and refocus on offline channels. And while there may be some legitimate reason to do some of that, we would encourage you to avoid moving entirely in that direction. The reality of the situation is that many consumers right now are still practicing social distancing, despite the official narrative of everything getting back to normal. And because of that, we'll continue relying heavily on digital purchases, likely through the second quarter of this year. So resist the urge to shift your focus away from online channel development for a little bit longer. Now is the time to continue investing there, even as you ensure that your offline channels are prepared to capitalize on any uptick that we see in demand as consumers begin to exhibit pre-COVID behaviors in increasing numbers. Now, of course, developing your online channels won't be sufficient to capitalize on demand. Over the rest of this year, it will also be important to consider how different segments are likely to perform, because the COVID-19 epidemic is going to have an uneven impact across industries in China. So to give you a better idea of what that looks like, we've mapped that out here. We've basically listed a variety of different segments on the left-hand side of the screen, mapped along with a quarterly assessment of the disruption or normalization that they're going to experience. Basically, what do the timelines look like for recovery across industries? You'll note that for consumer staples, packaged goods, food and beverage, at least retail food and beverage, we already see demand there normalizing. We're hearing that from clients quite clearly. Although within the alcohol and spirit space, the news is a bit mixed on that front. That's one of the reasons why, particularly for off-trade, we have them delayed a little bit into Q3 for any sort of normalization. In the same way that we've delayed on-trade services for them, restaurants and food services, as well as consumer durables. It's going to take a little bit longer for consumers to begin going back out to restaurants, begin thinking about purchasing major products that will take a hefty chunk of change, or even worse, would require financing. Similarly, residential real estate, which involve often very large investments, it's going to take longer to normalize than anything else there. And tourism and hospitality is going to take an extended period of time to recover. Likely, tourism and hospitality, even domestically in China, won't recover fully into next year. So to maximize revenue upside in the market, we strongly recommend that B2C firms use these timelines to prioritize consumers and industries that are poised to recover quickly and remain resilient in the coming quarters. So with that, I'll go ahead and turn things over to Pratima, because the India story looks a little bit different. Pratima, over to you.
Thanks very much, Adam. You're exactly right. The Indian story is quite different from what we've heard about China. And we're here actually to tell you that as it relates to India, the risks have in fact gone up quite substantially. So Adam, if you could go to the next slide. We wanted to start by sharing a little bit of sort of a snapshot, if you will, of what to expect in India next year, but even the year after that. But to give you some context and to sort of give you a sense of where we're at with India right now, it's obviously at a very different stage of the outbreak compared to China. India is one of the main countries that's driving up those active case numbers in Asia, and we expect that to continue well into Q2 at least. Just in terms of some context, the total number of cases in India has gone up to over 21,000 now. And again, very likely to be quite a bit of undercounting here. Specifically as it relates to asymptomatic or asymptomatic patients, but also as it relates to counting in some of the more rural areas of the country. And so essentially very large numbers, still a lot of uncertainty around I guess the actual numbers representing what's going on. But then that said, the implications for the economy are actually quite significant as a result of all of this. India is one of the markets that's most at risk at this point. And it's only likely, all of our projections here are only likely to be facing pressure to the downside rather than the upside at this point. To give you some context in terms of what this means for the economy, we have been revising our 2020 number for economic or GDP growth down quite a bit. We started with about 5.8% growth in this year in January. That was from our January vintage forecast. And now we are at 0.6%. And so essentially this means it's been a substantial shift down. Most of that shift is because essentially if we look across the drivers of the Indian economy, whether it's investment, both public and private, consumer spending, and exports as well, all of them are in negative territory right now. Of course, lots of pressure from the global economy when it comes to exports, very, very significant pressures from the Indian domestic, I guess, sector when it comes to private investment. Consumer spending also will be extremely weak. We'll talk about this in much more detail. Of course, where consumers are spending will be pretty important and critical going forward. But just to give you that sense that the only silver lining in all of this, if you can call it that, is government action. And here what we mean is both in terms of a little bit of that fiscal stimulus that's coming through, very marginal relative to many other economies, not just across the world, but even in Asia. But also in terms of government efforts to contain the virus. We've seen a lot of sort of focus on locking down. India is basically just going to come out of a nationwide lockdown in the next few days. The government is attempting to open some industries in some places. So there's a bit of that, I guess, ad hoc lockdown measures and strict restrictions that are being tweaked. But there is a lot of pressure still on the Indian economy as a result of all of this. So what does this mean in terms of the numbers? What should we expect from India for the rest of this year? So we wanted to show you a little bit on how this GDP, but in particular how this consumer spending number breaks down by quarter. So Adam, on the next slide, if you could just move to the quarterly numbers, we wanted to show you what this means. So essentially, our assumptions are that the economic shock in India is going to be the most significant in this quarter, the April to June quarter. This is because, of course, as I mentioned, the country's been in lockdown for most of April. We're going to see partial restrictions being lifted across different places for the rest of Q2. And even then, there's a big risk here on some cities and states opening up a little bit too soon and then having to lock down again. So there's quite a bit of that uncertainty and confusion. So as a result, we expect most of the impact to be contained in, or to be experienced in this quarter, Q2 of 2020. Going forward, in the July to September quarter, we expect very gradual recovery because essentially we'll see at least for the first month, maybe a little bit of that spillover come through, possibly even to the rest of Q3. In Q4, which is the October to December quarter, we expect a little bit more of that recovery. So we'll see a little bit of that acceleration, although there's a very significant risk that both Q3 and Q4 numbers are revised down as Q2 numbers are revised down as well. But really the silver lining here in India's fiscal year growth, at least, comes from the January to March quarter. So we're expecting that numbers start improving and consumer sentiment, spending starts picking up only next year. Again, this is based on the assumption that the virus doesn't re-emerge. If it does, then we will be looking at all of these numbers again. Now, the reason we bring this up is it's critical to understand what are the assumptions that you're making for the India business in terms of recovery, in terms of amount of shock even, and then also aligning with your local teams, because not only are they in the middle of it all, they're also hearing information from different sources, and different states and different cities are doing things differently. So it's critical to align on what to expect in terms of the timelines for recovery, both with local teams and also with headquarters, because again, the information that they're receiving from India is pretty different. Risks, just to sum up, risks remain pretty high. All of our numbers are experiencing pressure to the downside, but so far we're expecting sort of an elongated recovery, extending all the way through to Jan to March next year. I mentioned a couple of times the fact that different states and cities are basically going to be easing and imposing restrictions at different rates. So Adam, if you could go to the next slide, maybe we could talk a little bit about how this is actually executed on the ground. Basically, what's happened is the national lockdown that the Modi government implemented at the end of March extends all the way through to 3rd May. But since the beginning of this week, so earlier 20th of April, the government announced that they would allow certain sectors, certain geographies to sort of come back online. What this means in practice is that there's a whole lot of confusion in India right now. Basically, what they've done is they've categorized different districts and cities into zones. So they've got red zones where you have the most number of cases, you've got yellow zones, and then or orange zones, and then you've got green zones. Green zones are the zones that are experiencing or haven't experienced active or new cases for about a certain amount of time, and as a result are more likely to come back online faster. Now, what this means is that basically you're going to see India at different geographies in India at different stages. As you see from the map here, though, a lot of the cases are concentrated in specific states. So Maharashtra, which has Mumbai and Pune, the western state of Maharashtra, along with Gujarat, which has the Ahmedabad city, as well as the Delhi NCR region. These three geographies actually states contribute a lot. They contribute almost half of the total cases in India altogether. This is important to note because as B2C companies, these are also the centers, generally the centers that have the most affluent consumers concentrated. And so what's going to happen is, as a result of these states and cities experiencing the most strict and severe lockdowns, we're going to see a lot of pressure on consumer spending, particularly on some of the more discretionary and non-essential spend, because here you see some of the more affluent and wealthy consumers concentrated. So this is essentially important because it's going to have significant pressure on demand for your product. Some other cities, I guess, that are a little bit more, I guess, top of mind for many consumer companies, like For instance, Chandigarh, Jaipur, Hyderabad, Chennai, maybe even are experiencing mid levels, I guess, of case count in terms of the COVID outbreak. A couple of green, I guess, spots here, if you will. Bangalore, for instance, some of the Kerala cities are experiencing a bit of or a decline relative to the rest of the country. So this is really important because this is going to have a significant impact on your decisions on where to invest, how to enhance your sales team's efforts to be focusing on the right geographies at the right time. This also obviously has impacts for supply chain because we've heard of stories on how moving goods across borders, state borders, even for essential items has been challenging. And so knowing how to basically manage your supply chain as a result of this different sort of levels of restrictions across different states and districts even now is going to be even more critical. Now, speaking of some of the demand side factors, I also wanted to quickly show a little bit on what is happening with the Indian consumer as a result of this COVID outbreak and what to expect for the rest of the year. So Adam, if you could move to the next slide, please. We have seen that following the COVID outbreak, consumers that were already sort of a little bit more pessimistic about their expectations from the Indian economy, have now started sort of tightening their purse strings even more. So consumer spending on discretionary and non-essential items has decreased. You can see that on this visual here. The dark blue line, the dark blue segment basically represents a decrease in purchasing on certain items. So things like any sort of personal sort of, any sort of, I guess, non-essential expenditure, whether it's non-food child products, apparel, a lot of holidays, of course, travel, international flights, consumer electronics as well, have been in the dark blue, are more tilted to the dark blue, which means consumers are postponing that spend. The only categories that we see some sort of a higher spend on right now are things like groceries, some household supplies, of course, and an improvement in entertainment at home, essentially. So this is critical because this indicates changing consumer preferences and needs. And as a result, we recommend that companies revisit portfolio decisions. If they have the option to, push products that can be sold either on grocery aisles or any sort of slightly lower priced products rather than more expensive celebratory products would be critical. We've heard this from several of our alcohol and spirits companies as well. And it's also important to be able to tweak your marketing strategies in response to some of this change in consumer behavior and sentiment. Now, speaking of tweaking strategies, I wanted to kind of show you a little bit on how to, what our expectations for different segments in India. So Adam, if you could move to the next slide, please, and how to capture some of that sort of resilience in certain sectors. Now, the first thing to note is a lot of India is still going to be in facing some sort of disruption all the way through to the end of this year. And so we recommend that businesses examine their exposure to those segments, whether it's things like residential real estate or tourism, hospitality, even some consumer durable segments, in order to get a better sense of how to plan going forward. We don't expect either tourism, residential real estate to recover back to normal in this year. And consumer durables, we expect only some sort of slight recovery at the end of this year. However, where we do see some recovery earlier, particularly in Q3, would be some of the more essential spends. So consumer packaged goods, retail, food and beverage would likely experience a little bit of that improvement in this year. And as a result, ensuring that you're identifying the resilient sources of demand, beg your pardon, and then training sales teams or distribution partners to target those segments is going to be even more critical. And this is very much in line with what our executives are also prioritizing in India for the next year. So if we go to the next slide, please, Adam, we'll show you the results of a poll that we asked our B2C companies from that virtual executive roundtable that we held a couple of days ago. We asked them what is their most urgent priority in India for the next 6 to 8 months. And you'll see the responses pretty clearly highlight a focus on E, which is developing our sales teams and distribution partners' capabilities. Now, this is basically in line with understanding how to help them focus, managing their marketing strategies, their messaging, and really working with them to be able to capture whatever opportunity is there right now, but also target those segments that are likely to recover quicker. The other area of focus is, of course, reprioritizing geographical states and cities. Given the shifts and changes that are taking place in India, that's become a priority. We've also seen some companies discuss their investment in digital channels, for instance. Of course, also protecting against working capital and liquidity issues remains a perennial concern for companies in India. So I'll leave you with that on India and hand things over to Ashu to talk about our outlook for another very critical region in the APAC portfolio, the ASEAN markets.
Perfect. Thank you, Prathama. Very much like India and China, so very much like India and unlike China, Southeast Asia is very much in the middle of the COVID-19 situation right now, rather than coming out of it. And looking at our forecast revisions for consumer spending on the next slide, you can see that we have made very substantial downward revisions to our forecast for 2020. While consumer spending was expected to grow at about 6% in several countries previously, now growth in all markets is expected to be below 2%. The largest downward revision has been made to our numbers in Thailand, where consumer spending is expected to be in very deep contraction. This is largely because of a significant amount of incomes being linked to trade and tourism, both of which are areas which are likely to see very significant disruption this year. Indonesia is also expected to experience a significant impact, but you might notice here that our numbers for Indonesia have not been revised by as much as how we've revised for some of the other markets. And that's because the impact on consumer spending in Indonesia will not just take place in 2020, but will also significantly spill over to 2021. The government in Indonesia does not really have a proper plan in place, and that will make it very difficult to contain the virus early on, and will also make it difficult then to recover rapidly during the year. On the next slide, we also highlight some of the primary drivers behind our consumer spending forecast revisions for the Southeast Asian countries. The first is the lockdown, which is causing significant short-term disruptions, particularly in Q2. 4 out of the 5 Southeast Asian countries being discussed today are currently on lockdown, and that is expected to drive consumer spending down significantly. This is because of supply side constraints, because a lot of non-essential or all non-essential businesses remain shut, and also demand side constraints linked to higher unemployment and lower income levels at this point in time. During the lockdown, consumers are also mainly cutting discretionary spending on non-essential items. And so countries in which consumers spend more on non-food items will see a larger decline. In Southeast Asia, this is the more wealthy countries such as Malaysia and Thailand. And so you can see that those are the ones which are expected to see the largest, most significant negative impact from that factor. And high domestic spread in a large number of cases is also a major point there. They will have an impact on consumer confidence levels and also affect recovery in markets to a certain extent, which would keep consumer spending growth down during the year. On the positive side, fiscal stimulus measures by the government is providing some support to growth. Various ASEAN governments have introduced substantial fiscal stimulus measures, and a significant proportion of those measures are dedicated to supporting consumers, particularly those in the low-income population. This will provide some support to growth, but it won't really compensate for the reduction due to the negative drivers. And so overall, we still expect a very substantial downward revision in our numbers. At this point in time, we also recognize that a lot of the executives are not thinking about these markets on an annual basis, but are looking more at the quarterly and monthly numbers. And that's what we have on our next slide for our consumer spending on a quarterly basis. We can see that we expect the largest downward revisions in Q2 across the markets in Southeast Asia, with a recovery beginning in Q3 once lockdowns begin to be eased. We expect the fastest recovery in Q3 in Malaysia, where the government is best equipped to handle the virus in this region. It has a relatively high testing rate, it implemented a lockdown relatively early, and it also has a better developed healthcare system. So we do believe that overall, it just has a better ability to be able to handle the situation, and also hence to be able to start easing the lockdown before we might see some easing in some of the other key markets. The slowest recovery will take place in Indonesia, where limited containment measures, as I mentioned before, will affect consumer spending for an extended period of time. What we expect in Q4 is that growth numbers will remain lower than in Q1, indicating a slow recovery and also indicating that spillover effects will carry forward to 2021. Finally, the overall variation in consumer spending over quarters is expected to be lowest in Vietnam. And this is where the government took early action to contain the virus and so has a lower level of domestic spread. We do not believe the numbers that are being reported. We do not believe the numbers that are being reported by Vietnam at this point in time, and we do think that some undercounting is taking place. But just given the fact that the government took very early action when the outbreak took place in China and that it continues to implement containment measures, we do think that it has a better handle on the situation. And so it will be able to start easing its lockdown relatively early. Apart from domestic consumers, tourists are also a key source of demand for many B2C companies, and that's what we highlight over on the next slide. As you can imagine, tourism has come to a practical standstill right now. And several of the Southeast Asian countries see very substantial number of tourists enter the country every single year. We expect overall the impact on tourism to last longer than it will on domestic consumer spending. And so tourism numbers will likely remain low throughout the year. As countries begin to gradually open up their borders, Thailand will likely be the first country to do so. This will provide some recovery in demand, but will also raise the risk of an increase in imported cases and also the risk of another round of outbreaks. What we've seen from the Thai government right now is that they're relatively more risk-taking on this front and have already started taking small, tiny measures to open up certain borders. Also, as countries open up their borders, they will likely open up first to China and South Korea. As you can see, some countries do see substantial number of tourists from these countries, and so they might see some uptake at that point. I would also like to note that competition at that point is likely to be very high, as many companies will be competing for the limited demand from tourists, limited demand from a relatively low number of tourists. The impact of these trends on the different sectors will really vary, and that's what we highlight on the next slide. Demand for FMCG goods, including food and beverages and other packaged goods, will recover relatively faster, but companies can expect consumers to be trading down. Non-essential low-ticket items such as alcohol and spirits and restaurants and food services will experience more disruption and a more gradual recovery. Particularly food services will take longer to recover, as countries will likely continue implementing some social distancing requirements, and that will limit large gatherings and celebrations. Large ticket items such as consumer durables and real estate will take longer to recover as consumer spending ability remains low. Particularly spending on real estate will remain low because of the significant investment it requires, and also as demand from foreigners remains low. As mentioned previously, the impact on tourism will take relatively longer to recover compared to any of the domestic consumer spending areas. Finally, on the next slide, as we did for India, we asked companies about what the key priority is for the rest of the year in Southeast Asia. Key priorities at this point in time we can see is managing capital and liquidity issues and developing sales and distribution teams. Liquidity issues are becoming more of a problem due to lockdowns, and as businesses at this point in time are facing a lot of disruption. Managing that will become increasingly important as lockdowns are extended, and also as companies in Southeast Asia, including distributors and customers, are not known for being very effective at managing cash even during normal times. Recent lockdowns have also resulted in a shift from spending on on-trade channels to off-trade and digital channels. Since several distributors are not used to selling into these new channels, training distributors and sales teams becomes a key priority. Also, as we mentioned, there is a shift towards digital channels, and that is also encouraging companies to increase investments in that area. This is all we have for Southeast Asia for today. I'll now pass the time for Raveen for some final remarks.
Outstanding insights. Thank you, Ashu. We would now like to begin the Q&A portion of the webinar. If you have any questions, please share them with us via the GoToMeeting messenger by sending your questions to Dakar Frontier Webinars. And in fact, it does look like we've had many different questions come in during the session. In the interest of time, we might have time to address a couple of questions. And I believe, in fact, we can maybe just pick our first common question that we've been getting from across the executives in today's session. And in fact, this is something that we've been hearing from many different regional executives, even during our virtual executive roundtable that Adam and Fatima had highlighted. And Adam, I think perhaps it would be a good opportunity to hear your thoughts on perhaps this first question, and I'll pick one from the group. It's really around how great is the risk that the coronavirus resurfaces later this year?
Yeah, I mean, at this point, speaking quite frankly, nobody knows exactly how this coronavirus is going to act, which is why we laid out those epidemiological assumptions when we laid out our timelines. Regrettably, many companies are not necessarily thinking that through, at least on a corporate level. As you saw from the polling results that we showed, most of the companies that responded, and indeed many of the companies we speak to, are building a recovery this year into their plans, and they are not building in any sort of contingency plans yet for 2021. But it's interesting. When we speak with senior executives privately, outside the context of leadership meetings, a large portion of them express skepticism about the validity of this view. There's a wide-held belief that the assumptions that are being built into many corporations' strategic plans for this year and next are overly optimistic, and that adjustments will need to be made in the future. And I think that this is indicative of the real risk that exists around this coronavirus's trajectory. Certainly political dynamics vary across companies, so it's difficult to push in this direction right now for everybody. But we would once again strongly recommend that companies begin thinking very seriously about what would happen within the context of their businesses if the coronavirus resurfaces later this year, because the risk is real, and companies that are not prepared for it, or who make all of their bets on the assumption that it will not happen, may very well put themselves in a very, very difficult competitive position.
Thanks, Adam. That was indeed very insightful. Once again, thank you very much, everyone, for joining today's webinar session. If I may ask for us to just stay on for another couple of minutes, and I think we may have time to address one final question before we wrap up. And I see that we've been receiving quite a number of questions on India, especially. And Pratima, it would be good to hear your thoughts on this. And in fact, just now during the polling results, and I know something that we've been hearing from India as well in terms of existing issues where we've seen the banking sector struggling in India, and that has created severe liquidity issues for B2B and industrial companies that we've seen. I think we've got a couple of questions around how B2C companies would be impacted by that.
Thanks, Raveen. That's an interesting question, and you're absolutely right. It's one of those issues that we've seen in India for a significant amount of time already, and it is very severe. The industrial sector in India has a very large share of bad loans on public banks' balance sheets. So that's definitely a big risk there. When it comes to B2C, we've heard a couple of things. Even in the formal banking sector, what we do find is that while loans to, say, personal loans to consumers still remains, it's come down, that's for sure, but still remains a little bit more in the green relative to other sectors. There are still issues with the channel. So we have seen that within the B2C channel, whether it's at the end to retailers or even through distribution partners, companies continue to face the liquidity and working capital issues within this channel. And so whether it's attempting to get accounts receivable back from retailers or engaging with distributors on their financial stability and therefore getting money back and understanding their inventory and working capital issues, that continues to be a big challenge in India in the B2C space. The other thing I'll highlight is even in the informal or the shadow banking sector, which is the non-banking financial corporations, that's where a lot of consumers tend to get their loans from for housing, for auto, things like that. And there we've seen a significant dip in the number of loans issued to consumers. And so combined with the end consumer, so through the non-banking channel, but also within the formal banking sector as it relates to retailers and distributors, we've seen a lot of issues even for B2C companies in India.
Thanks, Pratima. All right. It looks like we're nearing our time limit for today's webinar. I do acknowledge that we've received several questions, and for those that we were unable to answer on the line today, we will be sure to follow up with responses through your client services manager. So before we conclude, Adam, do you have any final remarks to share?
Thanks, Raveen. I'd like to finish this webinar by highlighting several key takeaways that we outlined throughout the session. So here are 7 suggested actions for you to consider following this call. First, plan for a recovery in China in Q2 to Q3 and a gradual return to normal activity across Asia in Q3 to Q4, and begin building contingency plans for a situation in which the coronavirus resurfaces in the Northern Hemisphere in Q4. Secondly, continue investing in online channel development in China. Many consumers are still practicing social distancing and will thus continue relying heavily on digital purchases. That is, do not buy the official narrative. And with that in mind, expect a recovery in consumption to lag a broader industrial recovery by at least 1 to 2 months. And wait for the industrial recovery to show up in the data, not just in surveys, because right now the surveys are skewed a bit by certain political imperatives. In India, monitor state and city level lockdown measures, which will remain in place once national restrictions are lifted and will be critical in determining impacts to business on both the demand and supply sides. Additionally, in India, revisit your portfolio decisions and your marketing strategies to account for changing consumer preferences, needs, and spending patterns. In ASEAN, consider reprioritizing your markets for 2020 because the impact of COVID-19 is expected to vary substantially across countries. And align with headquarters and your local teams on their expectations for recovery in key ASEAN markets. Ensure you are prepared for an increase in demand in H2, particularly ensure that your local teams in key markets are prepared for that increase in demand.
Wonderful. Thank you for rounding out the session, Adam. And that concludes our webinar for today. Thank you everyone on the line for joining us. We look forward to speaking with you again very soon. Have a good day.